Welcome everyone, episode number 32 of the Wide Lens podcast.
Welcome back.
I've got my co-host here, Matthew Rigby, and we are recording this on the Friday the 16th of September. Now, I'm going to hand over to Matt for his market minute, but this market minute is going to go for
a long time.
I feel like this whole segment needs to be changed from like market minute to, because I feel like we're going to cover today like a lot more than just what's going on in the market, more like economic data. What else we got here in the doc? There's a whole bunch of stuff. So probably not so much just on stocks, but economic, financial, and a whole bunch of things. So I'll hand over to Matt. We'll kick it off, and we'll go from there.
All right, we'll get through the usual stuff first. So the Aussie market basically flat over the last 5 days to last night's close.
Not fat.
Not fat. Down about 10% year to date. A couple of stocks that caught my attention this week. Star Entertainment, the casino operator up in Sydney, they were up about 5%, which surprised me.
Shambles.
But have found to be unsuitable to hold a casino license in New South Wales. And yet they're up. So I don't know what the market was expecting.
Cut costs.
Maybe
you don't have to pay your license fees. Cost reduction.
Well, maybe they just become a property play. They rent out the land. Who knows?
Do they own the building?
I think they do, yeah. Much like Crown own their casinos. Link down 23% on concerns that the conditions that the UK Financial Conduct Committee are imposing will see the takeover deal basically untenable. It's unlikely that the Canadian company, Dyer and Durham, I think is their name, unlikely that they will want to kind of stump up the funding that the FCC are asking for the deal to go through. Atlas Arteria, the toll road company, in a trading halt, they're down about 1.6%. They're looking to raise $3.1 billion to buy Chicago Skyway, which is a toll road, raising money at $6.30 a share from the previous $7.80 close. And Ramsay Healthcare, down about 11%. KKR basically came out and said not willing to renegotiate the deal, and noting that after they reviewed the financial year 2022 accounts, there is meaningful downside pressure on the proposed valuation. So
called their bluff.
Basically.
It's like, man, just take the deal.
Take it. Should have taken the deal. Walk away. Yeah, absolutely. So a little bit of argy-bargy going on there.
Sounds like Elon Musk when he reviewed the number of bots in Twitter.
Yes, absolutely.
On reflection.
Which is, damn it, having buyer's remorse or bidder's remorse. All right, the NASDAQ down 3.4%, down 27% year to date. 54 stocks now down more than 20%, 13 in positive territory. S&P 500 down 3%, down 18.6% year to date. 126 stocks or 25% or thereabouts in positive territory. 206 down more than 20%, not recovering. And this week was pretty nasty for the markets. One day in particular,
so it's almost like it's not getting better, but it's not getting worse.
Yeah, it's almost like one step forward, one step back.
Yeah.
The markets had a good rally late last week into this week. Inflation gets released, bang, we just give it all back and start again. Only a couple of relatively interesting.
Right?
Which one?
You go on, please.
Yeah, Adobe down 20%. So they beat earnings, but they announced the purchase or acquisition of a company called Figma. The thoughts are that they're paying a bit too much, so paying about $20 billion for this acquisition. One of the most expensive they've ever purchased.
What do they buy it for?
Well, it won't be. So $20 billion. I don't know what they bought it for a share, like $1 per share.
No, right. So what's Figma looks like a Canva style
enterprise software.
Yeah, chatting to a couple of guys, and they're like, I just don't know how like designers use Adobe software where you've got the likes of a Canva now that can be done so quickly.
Okay.
Yeah,
wow.
But I guess you talk to designers and creatives, they'll always stick to the the Adobe software. I mean, it's far more advanced. I mean, Canva's just, Canva's for the masses, right?
Right, okay.
But it looks like a Canva-like tool, and it's good to see Adobe bringing sort of a lighter solution. They've tried to do it, but with some of their other products, but it just, it hasn't really
hasn't worked.
grasped, and the market hasn't really grasped it.
Yep. Yeah, well, it's interesting. So this deal won't be earnings accretive until year 4. So, they're paying up for it in a down market. I think that's where the market are a bit concerned. Oracle missed. They're down about 6%. FedEx missed aftermarket. No, sorry. They missed aftermarket down about 16%. But they withdrew full-year guidance, and this was the really interesting part. Said that global volumes declined as macro trends significantly worsened later in the quarter, both internationally and in the US. So if you think kind of, are they a fair representation of, activity, whether it be business or, just sending packages, obviously, but sending stuff around the country. Amazon, their business is based on sending stuff around the country. So a significant, that was kind of the word that jumped out at me there. So that's interesting, something to watch as we go into the holiday season over in the States. Twitter, you mentioned earlier, up about 0.6 for the week. Shareholders approved Elon Musk's $44 billion takeover bid.
I thought this was just dead.
For whatever that's worth. It pretty much is. So interestingly, this week also the whistleblower within Twitter, Peter Zatko, I think his name is, told the Senate Judiciary Committee that Twitter misled its board, investors and users about its security and the prevalence of bots on the platform.
Oh, right.
Which Elon Musk has jumped on and said he's obviously in court at the moment going, this is why I'm wanting to back out of the deal. So I imagine that deal is dead, I would think.
Right. So what Elon was talking about the bots, was actually true.
It would appear.
Right.
Allegedly. And lastly, Peloton.
Elon's the whistleblower.
Might be. Oh, wow.
He's doing good in the world, isn't he?
Mate, he's out there giving it a crack. I love that, just nothing's an obstacle. Everything is solvable. I think that's what I like about his attitude. Peloton up about 15%.
Yeah.
Their chief executive and co-founder, John Foley, stepping down. Nothing helps your ego like the market going up when you leave. But I would imagine there's further shake-ups there to come.
Yeah.
Capital raise probably in the offering at some point, and they're in a whole lot of trouble.
What's their market cap now?
Oh, far out. I don't know.
Wow. Just take a guess.
10 billion.
3.6.
Oh, shit, really?
Yeah.
Wow. Thought I was being conservative. Emerging markets, as gauged by the VGE Vanguard Index Fund, up 0.2 for the week, down 13.3 for the year. Oil down 2.3 for the week, up 13 year to date, sitting at 84.70 US a barrel. And I came across this in Bloomberg. We'll just bring this chart up now. This is a graph of the US's Strategic Petroleum Reserve. So a pretty significant decline. It's kind of been declining for a little while, but really since the start of this year, it has just dropped off the face of the earth.
So what is the Strategic Petroleum Reserve?
So this is just the US
it's like a secret
stockpile of oil.
Right.
Yeah. So they kind of keep it there for emergencies. When prices are too high, they release it. When prices are low, they kind of build it back up again. So that's fallen off a little bit. Bloomberg was sort of suggesting maybe this is one component.
Wow, it's been falling since 2017.
Yeah.
5 years ago.
But look at that last dip.
Oh,
I mean, that's
literally
kind of the last quarter
of
last year, right?
Yeah.
And it's almost vertical at points. But anyway, whether that has factored into the recent price decline, I don't know, but I just thought it was pretty interesting because it's often given as a reason why oil prices are going up when they're building. So I guess conversely, when they're depleting it, it drops down. All right, Bitcoin down 9% for the last 5 days. It was up strongly over the weekend, which is not captured in that, but down 58.7% year to date, sitting at 19,679 and 70 US cents for a coin. And this is something that caught my eye, which I know zero about, but I'll just regurgitate what I read. So the merger is coming for Ether, apparently, which basically means that Ethereum, then with the network that runs Ether, it's the second most valuable coin. So it's getting a makeover, which essentially the whole deal of the software change is to make it more energy efficient. And they're expecting it to be 99% more energy efficient, or basically save 99% of the current energy that you're using, which is massive.
Just think about like what the internet was like back in when was the first time you used the internet? I'm sure you remember.
Late 90s.
Where were you?
I was at uni, I think. And do you know, funny story, it's going to embarrass me, but I remember not knowing anything about it. I was like, what is this thing? I heard about this. MBA.com. I didn't know. Like I was MBA.org? .gov? Like I had no idea what the extension meant that eventually got there.
Yeah.
Yes,
but the point that I'm trying to make is I remember me and my mates distinctly remember the first time we used the internet. It was a computer shop in Doncaster. After school, we had to book time to use the computer, like 5 of us. It's $10 for like 10 minutes or something of internet. And it was the slowest thing on earth, but it was like, wow.
What were you?
NBA.com.
I was going to say Googling. What were you?
It was the first thing NBA.com, right?
Funny
and I think we were, when was it? Late 90s, mid 90s.
Yeah. Okay.
First time mid to late 90s, first time we used it.
Yep.
And the point that I'm trying to make is that you think about the efficiency and the advancement that has happened since then.
Yeah.
I mean, it's only 25 years, more or less. Maybe 20 years for most people who have connected to the internet, right?
Yep.
2002.
Yep.
And so think about the evolution from there and think about how quickly now cryptocurrency and digital assets, how quickly they're going to evolve and the efficiencies they're going to gain. I reckon, it's mind-blowing, but I think it's all relative and the advancements that we make now are going to be far swifter than the advancements that were made in the early 2000s.
Yeah, absolutely. And that we're seeing that in AI and a whole bunch of other things, that the advances are advancing at a faster rate. And, things are happening much quicker. So that's interesting. Makes it more energy efficient, possibly makes it more usable. So we'll see. Anyway,
so is this the new segment we've got now, the Matt's Economic Minute?
Yeah, this is it. I've put a new one in. Just for the record, Bitcoin and Ether are both down about the same amount. Both down about 59%.
Sure.
Which was surprising. All right, economic. Here we go. This is where it gets really interesting.
We will slot a new chapter into the video.
All right, so US CPI numbers came out at 0.1 for the month of August, which doesn't sound like a lot. Expectations were negative 0.2, so deflation. But the market basically shit itself. Annual inflation rate headline is at 8.3, down from 8.5. Expectations were 8.1, so in the mid-range there. But I think
hold on, we were down, but we weren't down as much as
expected.
So who was right? The market was wrong.
Yeah, the market's wrong. I'll get to that in a little bit. Annual food inflation, 11.4%. So that's the fastest pace since May 1979.
Food, right.
For food. And electricity, 15.8, the most since 1981. Now, they're both headline. So let's bring this chart up now. And I didn't see this really commented on all that much, not to say that it wasn't. But core inflation, this is kind of where it's starting to get really interesting. So the headline's at 8.1. That includes the volatile items like energy and food. The core number, and that's the one that the Fed tend to focus a bit more on. That was at 6.1. That was up 0.6% versus an increase of 0.3 expected. So basically, the core rate is increasing at twice the rate of what the market was expecting.
You can see it jumping in that last bar.
Yeah, and it was sort of trending down, and I think this is why the market really reacted quite strongly. And the other factor is that of the 7 key categories within core, 3 of them were fairly minor increases. So the one was apparel was up 0.2, medical devices effectively were up 0.2, used cars were down 0.1. But the other categories were up fairly significantly, more than 0.5%. Up to 0.8%. So the vast majority of the core is still increasing at a pretty strong rate. With the Fed kind of saying that, Jackson Hole, Powell basically said a single month's improvement falls far short of what the Fed would need to see before being confident about that inflation's moving down. So if we've got core inflation still increasing at a fairly rapid rate, interest rates are going much higher over the course of the year.
Yeah, but I think that's such a to the comment you just made that it's a 1 month data point. It was a 1 month data point that the CPI was improving and core CPI was improving. And now we've got, there was clearly a downward trend, as you can see on the right-hand side there, whereby we peaked during March.
Yeah.
And then even though headline was increasing, core was decreasing, the Fed said that we're just going to see what the data tells us.
Yeah, I think that the concern, though, is that each of those core areas were increasing at a faster rate than they were the previous month.
So look at the core, man. New cars, okay, secondhand cars are, if you look at Manheim, their index has just absolutely plummeted. Shelter, so homes and mainly rent. And I've got a chart to show you later on, but rents in Australia, mate, they're going bananas.
Yeah, and rents is the big one. There's some early indication that's maybe moderating. That's one that has been quite strong.
Transport, healthcare services.
But services, yeah. Services is the big driver. And, if you think about demand and supply, supply has been the driver for inflation recently. Services is purely a demand side of the equation, and that is.
And why is that? Is that because
really
wages are going up for service providers?
I would imagine so. Yeah.
Is that is that an immigration thing?
Well, mate, I've got no idea. I don't know what immigration's doing in the US, but yeah, inflation, wages you would imagine feeds right into services.
Does anyone even understand inflation? Like really?
Yeah. Well, the problem is that we're also focused on, as I've just talked about, 1 month. This month, next month, whatever.
It's like Chris Joy annualizing 1 month of data.
Well, that's what is that? A 7.2% increase annualized for the core. That's it's pretty strong.
It's a big number.
It's a big number. Anyway, so that's for that. The actually the other thing, kind of somewhat relating to that, initial jobless claims in the US. We'll just bring this chart up really, really quickly. Continuing to drop. So I think I talked a few weeks ago about initial claims increasing, and you can kind of see there it's really dropped off. 213,000 of initial, so new jobless claims for the last week. 226 was expected. The employment market is still incredibly strong over there. US PPI, so producer price inflation, was down 0.1, 8% annually. And the US Economic Optimism Index, I don't know what the hell that is. Sounds pretty cool. That actually improved. Just trying to find something positive there.
Well, talk about positive. I saw you putting some stuff in the doc, and I had a quick look at some of the things that you wanted to talk about, and it just kind of triggered me to look into some things. So I want to maybe add on to your Matt's
Go for it. Matt and Rob's economic hour.
You've been taking the limelight the last couple of weeks, so I feel like I have to...
Co-host has gone to my head.
Yes, ego's shining there. Let me bring this chart up here now. So you and I have talked about what's going on with the consumer. How is the consumer spending? What is the data telling us? Talk about credit card companies and so forth. This is from Bank of America. The chart on the left-hand side shows median household savings and checking or savings balances by income. And so the blue line's under 50K, 50 to 100 in red, 100 to 150 orange, 150 to 250 and 250 above, you can see. And you can see the savings rates since 2019, 2020, still very high relative to that of the pre-pandemic.
Sure, yeah.
Now, there's a very slow downward trend there, and that's probably going to continue and take time. And that's why I think this whole process that we're going through, it's going to be quite a slow and lengthy process, because we've talked about it before. Consumers are cashed up. They're in the best position they've ever been to withstand a recession. So it's almost like the two armies are fighting. You've got consumers and you've got, the Fed trying to dampen, but the cavalry here is still quite large, and so it's going to take these guys a little while to get through.
Do you mean the process of getting inflation under control?
100%. Yeah, because they can absorb it for a lot longer, right?
Yes.
The chart on the right-hand side is the share of credit card spending by value for those with both credit and debit cards. And so the blue line is 2019. The Reddies 2021, 2022.
Yeah, right. Look at that.
And so you can see spending, although for the under 50K bracket, it did drop slightly in 2021 post the pandemic, but we're back to pre-pandemic level spending. And in fact, look at the above 150K bracket.
They're above.
In 2022, they're spending more than they had in 2019 and 2021. 2020 is not in there, obviously, because nothing happened in 2020, but you can start to see the consumers are still spending. They've got the savings in the bank accounts.
Yep.
And so maybe it's just going to take a little bit more time. What do you think?
Yeah, look at that chart on the left is really interesting. I mean, look at the trend. First half of the year, savings increase. Second half, they spend. You know, I imagine that's summer and then into back to school, Halloween, Thanksgiving, and then Christmas, and then they save again. Consumers not in too bad a position. That's good, you know, because they're going to need to be.
The next one was, I read this article on Bloomberg. I'll just read the headline now. Amazon sellers see scary holiday season as consumers pull back, which is contradictory to what the data is saying, because the consumers are not pulling back, they're actually spending. Yep. For the first time, US online sales growth rate will be in single digits. Merchants fear they'll be forced to cut prices to goose sales. Quickly, I'll just read this. Amazon.com sellers are bracing, this is a quote, Bloomberg, racing for a bleak holiday shopping season as consumers slow their spending. Many merchants who sell more than half of the goods on Amazon's web store fear they'll be forced to cut prices to move a mountain of unsold inventory, something we've been talking about for a little while. Right? It's an abrupt change to the previous 2 years of the pandemic, where sellers scrambled to get enough products into Amazon's warehouse to meet the COVID-fueled demand.
Yep.
Even as chronic shortages let them boost prices. So in the past, it's been short of stock, can't get the stock, prices get jacked up, and now we're going through a situation where you've got a bit more flow in transit, in logistics, in supply, and they've got the stock and they're fearful that they're not going to sell, but the data's saying that people are still buying.
Do you think headlines like this change people's buying patterns?
100%. Because can you imagine just a retailer reading headlines like this and going, oh, so consumers are pulling back. Okay, shit, I might not raise the prices of my products because last 2 years, 3 years I've been raising prices and I've been fine. Yep. Maybe this year I won't raise. Maybe this year I'll drop my price. Can you imagine if one retailer does that and then...
Yeah, the snowball effect, right?
That's right.
Yeah.
So I think the headlines do genuinely make a difference.
Do you think consumers go, we don't need to rush out and buy stuff now, we can wait?
Probably.
Yeah. It'll be interesting to see what the sales are like in the Black Friday post-Thanksgiving, which we've kind of adopted as well. But certainly in the US, it'd be really interesting.
Deb was saying, she goes, I need to buy a new phone because her phone's all cracked and she can't charge it. It's water clogged. And she's trying to just drag it out for long. And I said, just wait till Black Friday sales. So I don't know. We'll just have to wait and see. Yeah. The second chart, I thought this was fascinating. I can't remember where it came from. Maybe not Visual Capitalist, I think Visual Advisor or something. Anyway, this is changes in mortgage rates versus house prices.
Okay.
And so let me try and describe this. And if you're listening to this, try and watch the videos, man, because it's bloody hard to try and describe these charts. Just jump on the video. You can watch the podcast on Spotify as well. So not only on YouTube. But what it's showing here is the annual change, house price change on the left-hand side. It's a quadrant, right? And on the horizontal bar, you've got mortgage rate annual change. So as rates change, the annual percentage change of rates, you then got a corresponding dot plot as it relates to what impact it had on price changes. Top left-hand quadrant, mortgage rate decrease, house price increase. Have a look at the cluster there.
Man, look at that.
Which is basically saying as rates decrease, house prices increase.
Lock it in.
Right? Bottom left-hand quadrant. Mortgage rate decrease, house price decrease. Surprising there was quite a few there.
Quite a few, isn't there?
Quote the advisor capitalist, I think that's what it is. During the global financial crisis, mortgage rates and house prices were both dropping. Makes sense, right? So they're the biggest ones. Top right-hand quadrant, mortgage rate increase, house price increase.
There's a whole lot more there than I would have thought.
That was the surprising one.
Yeah.
When mortgage rates have increased in the past, house prices have typically also increased. And the bottom right-hand quadrant, this is a shock to me. Mortgage rate increase, house price decrease, annual percentage change. Mate, there's
7 or 8.
1, 2, 3, 4, 5, 6, 7.
Yeah.
Quote the source, periods of rising mortgage rates have rarely seen a simultaneous decrease in house prices. This primarily occurred during the recovery from the global financial crisis. So you got 2011, 2010, 2010 again, September 2008. So this was fascinating to me that is where we are right now. We are going through mortgage rate increase, and either we're going to have some dot plots in that bottom quadrant there, or it's going to be in the quadrant above. Yeah. Mortgage rate increase, house price increase. What do you think?
US house prices are still going up. That maybe at a slower rate, and maybe it's getting harder and harder to sell.
The year-on-year change. Yeah. This is not looking at month by month or day by day, right?
But year-on-year, I mean, I don't know the year-on-year number, but I would bet good money it's up from 1 January to now in the US. With a couple of months ago, it's probably likely to be in that top right box. That's really interesting.
I was just going to try and bring it up, but you can start to see that it's starting to plateau now.
Sure.
But certainly the annualized, there's no decrease at this point in time.
Yeah.
Maybe we haven't had enough time to get an annual number decrease. So
maybe next year.
Yeah. So I thought that was really interesting. Now let's move on. Is this you?
Yeah, I've just thrown this one in. This is from Jim Reed, Deutsche Bank. Just pretty interesting it's just looking at the Fed funds rate and inflation and what kind of happens. So basically, the nominal Fed funds rate always exceeds the rate of inflation late in the cycle.
Nominal cash rates.
The nominal Fed funds rate, so the nominal cash rate always exceeds inflation. So that's
always exceeds inflation
late in the cycle.
And does that mean that
logically makes sense?
Makes sense, right?
That the Fed raise rates. Inflation starts to come down. The Fed keep raising or don't cut. Inflation plummets. We go into recession. Yeah. They cut.
You can see that on that chart, right?
But yeah,
that dark blue line.
Really clearly. So that dark blue line is heading up, and the core inflation, it's somewhat heading down. But yeah, I mean, I guess that it's off its high. So the Fed rate is still got a little ways to go. Deutsche Bank are now coming out and saying that the terminal Fed fund rate, that is the point at which they hit their high, will be 4.9%. It's currently 2.25 to 2.5. That's where it is at the moment.
We've got double to go.
Which I kind of laughed at as well. And then I kind of sat back and thought about it and go, okay, so the Fed have got a meeting next week. It's going to be 0.75 or maybe 1%. There's an outside chance, maybe slightly better than outside. So that gets us to 3%. Then we've got a meeting in November. There's none in October. At least a 0.5% rise. Then we're 3.5%. And then in December, I'm like, oh shit, we could get to 4%
by the end of the
year.
Really,
really easily. Yeah. So that kind of my reaction was like, crap. It's going to double. I thought, wow, we could do it quite easily, or the Fed could do it quite easily. And in fact,
if you look at the dark blue line, for those watching, you can see that chart. The dark blue line peaks, and then the grey bar represents recession.
And then it drops.
Not every single time, but
almost
every single time.
Yeah.
Peaks, recession, and that's why you and I have talked about recessions don't happen during a rate hiking cycle. They happen when rates peak
at the end. Yeah.
And so we've still got quite a while to go. And then it kind of intuitively makes sense. Like to your point, if you're at 4.5 or 4 at the end of the year, and then you got a couple more throughout the course of the first half of next year, and then you can, and I think Deutsche Bank is saying a second half 2023 recession, which
that kind of all sort of lines up, right?
Makes sense. But I wonder what happens to the stock market then and the bond market, because if we're there, the market's already looking 6, 9, 12 months ahead.
Yeah, it was interesting last what we were talking about, which is right, the stock market or the bond market. I think the bond market at this point, you would say, has probably got it more right than the stock market. Given the inflation number and now interest rate expectations.
And what's the bond market saying? Is that we're going to start to see cuts?
Late to next year, I think it is.
And are you saying the stock market's wrong to the extent that it's falling now when in fact it should be over? we've already gone through that process. We've had the declines. It should now be sort of more forward-looking.
I think what I'm saying is the recent rally in the stock market was probably a little bit premature.
Right.
You know, so we're looking at it going, who's right in terms of inflation and the economy? I think the stock market just moved a bit too quickly. And that inflation number has probably shown that, which the market has then gone, okay, the Fed do have another 150, 200 increase coming, maybe more, maybe 300. Whereas previously, I think that the market was expecting that the Fed was going to start raising by only 50 basis points, not 75, and that was going to start to taper off, and we're sort of near the end of that. And then I guess the flow-on effect is that they go too far.
Yeah, sure.
And we avoid that soft landing.
That's what the central bank's been doing for decades.
Yeah. So I think the fear or realization now is they're just going to, the soft landing's probably off the table.
Do you feel like...
if they raise by 200 for the remainder of the year, or more, 250.
Yeah. Do you remember when central banks used to raise by like 25 points, 25 points, 25 points? Do you feel like we're now so much more... I mean, if you think about that, 50, 50, 75, 50, 100, whatever the numbers are, do you feel like we've become desensitized to what's actually going on? I mean,
25, you'd be almost like, so you're not serious about it now. I think that's the message.
That's not what it used to be.
No. But now, like if the Fed came out and went 25 basis points, I think people would go, okay, things are better.
Well, Well, in the realm of possibilities, everything we've gone through over the last 2 or 3 years, I think you just can't rule anything out.
Absolutely.
I think that's the bottom line.
Yeah. So the 2-year Treasury yield, the yield curve. So the 2-year Treasury rate is 35 basis points above the 30-year rate. So we're inverted. 2-year to 30 is inverted, which is probably a level of inversion we haven't seen since 2000. So it's becoming more and more inverted, which is no big surprise.
Yeah.
And one other thing just on interest rates, been in Australia, I did laugh to your point about 25. James Garish at Market Matters was commenting on interest rate expectations here in Australia, and the market's pricing in about a 40 basis points rise, which his comment was good. We get back to a multiple of 0.25. Sitting there going,
okay.
What does that matter? It doesn't mean anything, but I think just makes it easier to
rationalise it, right?
25, 75, 50 as opposed to a 30 or a 40. But anyway, by the by. So Aussie unemployment rate, are we done with the US? You got anything else yet?
That's good. Let's move on.
Yeah. Aussie unemployment rate dropped to 3.4, increased to 3.5 from 3.4 in August. Participation rate was also up by 0.2. So, I don't know if that means anything. We'll know in time, I guess, as to whether that's a trend or just a blip.
Can I throw something in there now? So I want to, the Kook, I saw this from the Kook on Twitter. Incredible data. Australia has effectively run out of properties to rent. And this is when the international borders are opening up to high immigration students and tourists. Rents will continue to surge. Australia does not have enough dwellings for its actual prospective population. And I'll bring this chart up now. This is from SQM that I came across yesterday. Louis Christopher from SQM shared this. So this is national residential vacancy rates. You can see that chart with the blue vertical lines and that purple red kind of vacancy rate. So the national vacancy is at 0.9%.
Jeez.
So there's basically, there is no vacancy in the country.
And there's only one way for rents to go. Yeah.
And so when you talk about inflation and shelter, I mean, in the US, it's a little bit different.
Sure. Massive.
The US is no different. They have an undersupply of property.
Yep.
And so we go back to fundamental economics, which is supply and demand.
Yeah, absolutely. And your point about migration is huge. I mean, if you bring, I don't know, however many people into the country, that vacancy rate just...
The thing that I'm not sure about is like students with all the universities now offering online courses. You don't actually have to come here to study, at Melbourne University or whatever it is. It's all done online now. So I don't know what that's going to mean.
But is the driver to come here to study or to come here to then stay as a resident?
Yeah, but maybe people don't want to come here to stay as residents anymore because everything that we went through was lockdowns. It's like, well, why would we go do that? But then again, maybe as COVID becomes something that you now read in history books more than anything else, maybe that chapter passes and people kind of get back to what they were doing before. I don't know.
Yeah.
I think that's a really interesting point. But what the data is showing, as we sit here right now, vacancy rates are at 0.9%. The lowest that they have been, this data goes back to 2005, so almost 17, 18 years. No, in 2006, it's 1.8%. I've had a look at the data. So
is it?
Yeah, 1.8.
Yeah, right, okay.
I'm sorry, maybe, no, that's not right. Anyway, it's
looks probably slightly higher, maybe 1%.
I'll have a quick look now as we bring it up.
Which is 20,000 vacant. I mean, that's nothing, right?
I'm sorry. April 2006. I'm sorry that it's 0.8%.
Okay.
And now we're at 0.9. So we're basically the same where we were back in 2006.
Yeah, right.
And then the other headline I read from Bloomberg was, quote, Australia gauges suggest household firms weathering rate rises. Westpac consumer sentiment climbs for the first time in 10 months, consumer. NAB business confidence and conditions both strengthen further. So it's interesting, the data point you've just pointed out with employment, yet consumers and businesses are feeling slightly different.
Yeah.
Maybe
and
the tide's turning, possibly.
Maybe, and maybe that was just purely from participation rate. Yeah, the participation rate increased so that...
More unemployment.
Yeah, so I mean, that makes sense, and that's probably a healthy rise. Hey, does that surprise you, the consumer sentiment climbs for the first time in 10 months?
It does surprise me. Yes and no, because every time we look at data, you and I have always talked about how pessimistic the consumer is.
Yeah.
In fact, equally, if not more pessimistic than, certainly more pessimistic than that of 2020. Equally, if not more pessimistic than 2008.
Yeah, that's right. I don't know. I'm just trying to think about myself with the rates. Rates are not nearing an end, whereas 6 months ago they were only just beginning.
Climbs.
So
why is it climbing? It's interesting. I don't know.
Why is it climbing now? And I don't know. I mean, it's
maybe does it climb because the worse things get, the better the outlook is, and maybe we've just got to a point where people are like, shit,
it can't get
worse now.
Maybe it's because we've come out of winter and people are like, fuck, thank God. Who knows? I mean,
maybe
consumers, the people, we're weird.
Let's move on.
China. So we're still going through it. Sorry, people.
China, a worldwide tour.
Yeah, China's August inflation was deflation, down 0.1, which is interesting because China has long been an exporter of deflation around the world. So that was fascinating. 0.5% was the increase in July. So they've gone from positive 0.5 to negative 0.1. I think their annualized inflation was sitting around 2.5, 2.8%. Super, super low.
It's funny that's low.
Yeah, well, it's the range, right, that everyone else is trying to get to. Okay, across to Europe. So September economic index declined to negative 60 from negative 54. It just gets worse. UK GDP came in at 0.2. 0.4 was expected. June's was negative 0.6, so it's increasing, but still not really going anywhere. UK unemployment claims rose by 6,300. Unemployment rate declined by 0.2 to 3.6. And the average earnings, so incomes, increased by 5.5% over the 3 months to the end of July. So wages are going up pretty quickly over there. The expectation was 5.1. So wages are rising. Inflation, as we know, is off the charts, and we got the inflation number for August. It was up 0.5%, 9.9% for the 12 months to August. That's going to get worse. It's just not looking great.
for Europe.
I tried to find some positive data from Europe and just couldn't do it. So I'll keep looking.
Can I add to your
all our
pessimism?
Sure, let's pile on.
So your topics that you raised last week for the European crisis and the gas crisis and what's going on over there, I saw this from Deutsche Bank and I just thought I have to add it in there. I have to add it in there. And so this is from, and I'll just get this chart up now. This is from Deutsche Bank, a depletion of gas storage scenario analysis, assuming a 0% Russian gas flow. So what this is saying through to Europe, if gas is coming from Germany, what Deutsche Bank did was they assumed a demand reduction if we're from zero gas from Russia and it's coming in from Germany.
Yep.
A reduction of 20%, 15%, and 10%. What do German gas reserves look like?
Okay.
And basically, this is saying in the next 9 months, regardless of the demand reduction, the gas goes to negative.
There's only one scenario where they don't run out of gas.
They run out of gas. What?
20%. If you demand reduction of 20%.
20% reduction, and then
That's huge.
But you go from where we are now at 70%, and you get to what, 5 or 7?
Yeah.
Gas storage.
I mean, you're almost out. You just got to hope for a warm winter, I think.
So for context, this is quote Deutsche Bank. With a 15 and 10% reduction, storage is depleted in March and February 2023. For context, the EU wants all countries to voluntarily cut consumption by 15% this winter. German gas consumption was over 20% lower than the 5-year average in August, but this was a summer month with light demand. Winter might be a different story if cold. But it's not only just like, households. It's all the input into manufacturing,
absolutely.
Transport. There's just it's so much bigger than just people lighting their stoves and turning the heater on.
I mean, it helps, but the big one is, your big car manufacturing plants and industrial, right. And I mean,
there is a positive. On the positive side, Europe has done a very good job in building high storage levels over the last few months, but the bad news is the Russian gas flows from Russia stay at zero. It's going to be likely that some compulsory rationing is needed this winter.
Yeah, I was listening to a football podcast, dudes in the UK, and one of them was commenting that over the last 12 months, they replaced their wood fireplace with a gas fireplace. He's like, and now we can't use it. They're like, just rip it out.
Throw the logs back in there. Let's move on. Have you got anything else?
I got one more, mate. New Zealand. Thought we'd go across the ditch. GDP for the second quarter grew at 1.7%, which is pretty good. But their annualized rate is 1%, so they've had a bit of negative. But 1.7
for the quarter.
That's massive. So look out for the next quarter. What's happening over in New Zealand? Maybe they're firing. Mate, I'm done. 20 minutes for the market minute. Might even be more. Where are we? Oh, fuck. That's a bit more than 20 minutes. Sorry, everyone, if you're still there.
Look, let's see what we can cover in the next 10. I might cut a few things out of here. There's a lot to cover. The markets have just been going bonkers. Mm-hmm. The stock market's sitting on the fence. So we've seen, we've had this discussion about bear market rally. It's a rally. It's a bear market rally. It's a bull market. It's not a bull market. So I'll just bring this chart up now. This is one that I put together. It's been doing the rounds, but I kind of felt like I needed to do my own version. It makes me look smarter.
Why not?
So this is from Refinitiv, and it's the S&P 500 over the course of the last 18 months. And it shows in green, you can see the positive movement, and you can see the blue lines that I've drawn there. The green line rising through to 2020, through 2021 and into 2022. And then you start to see the fall, the market's falling. You see a number of rallies, but as you can see on the far right-hand side, it's not making new highs. And so the trend is down. The June lows, however, this is what is really interesting, and this is what will determine whether markets continue to push forward or whether we're just going to keep falling down and markets have not looked beyond what's happening at the moment. So the June lows, you can see I've drawn a very short line from the June lows to the low that we just saw recently,
September.
And so there's two things that are going to happen here. Either the market tests those new lows again, and we break through that bottom line, and we break through the June lows, which in which case it's going to be a bit of a free fall. Alternatively, we're going to start to see higher lows, and the lows are not going to test those lows of June.
Yes.
And if that green line crosses the upper blue line, I think we're going to start running into a bull market. And just to add to the suspense, the third option is that green line could breach that upper blue line and then fall back down again. So there's a few scenarios there. A couple of other charts I want to start bringing up. This is from Bespoke, and this is showing the drawdowns from all-time highs over the last 4 years. And Bespoke say, remember at their lows in June, the more growth-heavy equity indices like the NASDAQ, the FANG stocks, and the small-cap growth were down 35 to 40% from their highs. That was worse than the decline seen during the COVID crash, which is... I feel like it's genuinely mind-boggling to understand how investors are thinking about interest rates and what that means compared to a global pandemic where the world literally shut down.
And no one knew what the hell was happening.
No.
And when we can all see that consumers are still spending, company earnings are still pretty reasonable, and yet we've just, it's all interest rate.
And you've got the likes of Microsoft and whatnot coming out. They're still reporting pretty bloody good.
Yeah,
Apple's no
absolutely.
different.
Yep.
And I thought that this goes back to sentiment, I guess. What else have I got here? Let me quote this before I bring it up, because I think this is really important because this is effectively the state of play in the market right now. Quote Bespoke, today will be the 100-day drop for a 4% plus for the NASDAQ composite in its history going back to 1971. It will also be the 7th drop of 4% plus this year. 7th 4% plus drop this year. These types of moves usually come in bunches and during bear markets for equities. Last year, we did not see 4% drop at all. And over the 8-year period, and listen to this very carefully, the 8-year period from 2012 to 2019, we only saw 3.
Holy shit. Really?
And this year, we've seen 7.
Wow. Okay.
So why does this matter? I'll bring this chart up from Bespoke. They've done, since post-World War II, a 15% plus quarterly drop for the S&P 500, what the next quarter was, and we love these charts, what the next half of the next year was. And they also did one for a 20% plus drop for the 2 quarters, which is exactly what we've seen for the S&P 500. Let's just have a look at the 20% one. The next quarter, so we've seen it in 62, 1970, 74, 74, 02, 08, 09, and June of 2022, we saw a 20+% drop. Mm-hmm. The next quarter, the average return has been positive 8.51%. The next half of the year has been positive 21. The next year has been positive 100% of the time with an average return of about 31%. And the second half is also a 100% of the time return with a 21% return.
Yeah, right. Wow.
And it's no different for a 15% drop, 100% positive the half after and the next year with an average return of 15 and 26% respectively.
Yep. I mean, I think it just speaks to, we keep saying it, I feel like a broken record, but it's really difficult to predict these things. You stay in the market, and you've mentioned a few times, the best days usually follow pretty closely after the bad days. Long-term investing, right?
Super hard. And I think Bespoke just wrapped it up nicely. While it may not be easy to think positively at times like this is precisely the time investors should have been putting money to work throughout history. And the day that the market dropped about 3% the other day, last
Wednesday,
whatever day it was.
Yep.
And we chatted about this, but the best thing about trying to get clients and investors to think this way is when you don't have to make sort of proactive calls to tell people what's going on. Yep. You receive inbound emails from clients saying, buy.
I've been waiting.
Client instruction.
Buy today. Yeah, that's brilliant, and kind of means that they actually listen sometimes.
But I think fundamentally believe too, and trying to take as much emotion out of it as possible.
Yep.
Yeah, what do you got, mate?
Just super quickly. So September 15th, which was yesterday, marks the anniversary of Lehman Brothers, the Lehman Brothers collapse, which I didn't know until I read this from Bespoke. And they were just talking about September generally, and September's always referred to as a bit of a rocky month, as is October, I think, the major crashes. So they just did this quick chart, which somewhat goes against what you just said, but not really. It's very short term.
I'm talking long term.
Yeah, you're talking long term, and it's much better. But anyway, from the 15th of September to the 30th of September, over the last 40 years, 60% of the time the market has been down, and it's been down by about 0.5% on average. So they're just talking about kind of just the back end of September, like what is it that gets people all kind of riled up and bloody freaking out about things. Anyway, so I just thought that was interesting. It'd be really interesting to watch the next couple of weeks. I think inflation and interest rates, interest rate call next week, that's probably going to impact markets for the rest of this month.
Is it 21st, 22nd, something like that?
Yeah, I think it's one of those. And then we can hopefully start moving forward. Hopefully that inflation number starts to moderate. It's probably not looking great for the short term, but again, as we kind of round out this year, there's maybe some hope that some of those core inputs are coming down. I won't worry about the rest because we are running well into time. Let's director's cuts. Have you got
just one comment before you're talking before we go there. Before you were talking about the September, there's also studies done what the stock market does on rainy days and sunny days. So I think you can cut the data
absolutely
with and apparently rainy days people are a bit more gloomy, they're a bit more down. Sunny days they're positive and optimistic and they're buying.
Sense, right?
I mean, the other way to look at it is 40% of the time it's up during the month of September.
Sure.
60% of the time it's down.
When it's down by more. I mean, you're right. You can cut, slice and dice this any way you want, but
whatever happened to sell in May and go away? Is that still a thing? I don't know. Let's go into
come again.
Sell in May and go away.
Something?
Oh yeah, I don't know.
I don't know. All right.
What do you got?
All right. So really quickly. So Mickey Mantle, the baseball legend. So one of his mint condition cards. I can't remember when it's from. Pretty old card. Bring it up here. This is what the card looks like. Rob, what do you reckon this sold for? And I'll give you a little bit of context. So a few months ago, Diego Maradona's Hand of God jersey sold for $9.3 million. There's another baseball card that sold, I think in the last year, so sold for $7.25 million. And Muhammad Ali's Rumble in the Jungle belt sold for $6.2 million. They're all in the last few months.
Right.
So sports memorabilia is on fire. What do you reckon this card sold for?
When did it sell?
This week, a couple of days ago, Sunday.
4.2 million.
I'll give you another guess. It's higher than all of those.
Oh, get out of here.
Yeah.
15.3.
$12.6 million US dollars.
Who bought it?
For that car? Some bloke.
I was just thinking
the same guy that bought those
the
NFTs last year for...
Oh, yeah.
I don't know.
The way I thought about it was if those other memorabilia was... I just think about Muhammad Ali's Rumble in the Jungle belt.
Iconic, right?
Maradona's Hand of God.
Iconic moment.
Should that have been a free kick?
It should have been red carded. You're out of there, champ. And then England win. That was the goal. Anyway.
And then I thought if this was done more recently, then markets have gone down, interest rates.
Yeah.
No, that's interesting.
Other way, mate. Other way.
Mate, this is it. Alternative assets is where people got to be.
That's it. That's the new fund, the card fund.
The NFT fund. Yeah, interesting.
And I just brought up just this other one. So Kathy Wood, who we've mentioned a few times, she runs the ARC funds. So she went out shopping on Thursday Wednesday, whenever the market fell.
Yeah.
She went out and had one of her biggest market buying days ever, as we can see in this chart here. Again, question for you, this is a bit loaded. What was her biggest purchase on the US markets, NASDAQ, on Tuesday or Wednesday, whenever it was? What would you guess was the biggest position or the most amount of money she put into which stock.
Do they already hold the stock?
I already held it. One that we've mentioned on the podcast a couple of times.
I don't think it's Tesla.
No, not
Peloton?
Tesla. No.
What did she buy?
No,
what did
Tesla.
they buy?
Roku.
Oh, here we go.
So I think I might have to sell. It's a counter sell sign.
I thought they wouldn't be buying Peloton.
No, not a chance.
Peloton, a tech company.
Peloton, I don't know. Are they a company that's going to be around in 12 months? That's probably a more poignant question.
I've got something ridiculous.
All right, mate. What do you got?
This is Bloomberg. I read this quote of Bloomberg.
So, what the hell?
The US and quote: US and China must find a way to avoid conflict on the moon. They can't. They can't fucking avoid conflict here. They have to avoid conflict on the moon. We both suspect the other of planning to make territorial claims in violation of the Outer Space Treaty.
Who has an outer space treaty? I mean, Jesus.
A good starting point would be... So, this is what they're saying. A good starting point would be declaring historic landing sites protected as the common property of humanity. That would set a precedent for future cooperation. What the fuck are we doing? Humans are now claiming territorial rights to
on
planets.
The bloody moon. Wait till Elon gets over to Mars.
And this is very upsetting. Like it is, it is deeply upsetting because it like to me, I feel like what are human beings? Where are we at
have we not learned
progress?
Anything? I read that that there's plans for mining and exploration on the moon. Like,
what for?
Can we not?
Just
can
leave
we
the
not
moon.
just fuck up one planet? Do we have to just go and just take them all out? Like,
did you watch David Attenborough's documentary? I can't remember what it's called, but he talks about how we're killing the planet, and it's actually not the planet we're killing ourselves, because the planet and the Earth and the universe will continue to thrive.
Yep. Once we're
post
gone,
us,
right?
And so
It'll
in
recover.
fact we're killing ourselves with climate change and whole. You know, I won't go into all that now, but have you watched the documentary? It is.
I've seen quite a few.
If you haven't seen it,
this one.
that's my bloody tip and recommendation as well. After this,
Which one is it?
Bloody hell, that was not my tip and recommendation.
All right.
It's on Netflix.
He's got a few. I feel like there's been a few recently that he's put on, or that have been put on there.
A Life on Our Planet, I think it's called.
Okay.
Yeah, that's right. It's deeply disturbing actually, and it's a beautiful, beautiful documentary, and yeah, absolutely fascinating. And you should watch that. Maybe more people should watch that. Make some different decisions in life and choices. All right, what do you got for tips and recommendations today?
So a show that I started watching after it being recommended to me by one of the parents from the kids' soccer team. What's that?
Not me, clearly.
No. It is called Welcome to Wrexham. So this is a documentary. It's on Disney Plus. It follows...
How many streaming services do you have?
Fuck, mate. All of them. Too many. Not Paramount Plus.
I've seen Paramount Plus advertising.
The only one I can think of we don't... yeah, I don't know. We've got a lot. Too many.
It's a comedy.
The irony is I never get to sit down and watch TV.
Clearly you do, because you've got a new recommendation for a show every week on one of these streaming services.
Wow. Trust me, I'm scratching.
Okay.
Some of them I watched
You
a while
just watched
ago.
the trailer.
Yeah. So the trailer said. No. So this is released every couple of weeks, I think.
Oh, yeah.
So it's Ryan Reynolds, who you probably have heard of. Rob McElhenney, I don't even know, from Always Sunny in Philadelphia.
Oh, yeah.
And Saturday Night Live. Anyway, so these two dudes have decided to pool their money and buy Wrexham Football Club in Wales. Interestingly, one of the oldest sporting organisations in the world, and they have the oldest international football stadium in the world. Something like 150 odd years old is their stadium. Anyway, so these guys have basically just decided to go and buy this Welsh football club.
It's a true story?
True story, yeah, absolutely. And really, really interesting. So Wrexham were good many, many years ago, not so much anymore. But what I like about it is it's about football, but it's not really. I mean, it's kind of about everything around it. You know, the people, the fans, the interview fans, and just what it means to people to have the club or prospects of the club being good again, what it does to the community. It's just really, really interesting. I kind of like. I mean, there's quite a few like this. Sunderland Till I Die.
Just
I think
one
is
season?
Yeah, just one season at the moment. There's 7 or 8 episodes. I think they released 2 last night or something. I got a message. But anyway, well worth the look. Really interesting. If you're into sports, not necessarily football or soccer, you'll probably enjoy it.
What's out of 10?
Pretty interesting. Mate, at this point, I'm going to give it a 7. I'm sitting on the fence. I'm just waiting to see where it goes.
Okay, maybe you need a few more episodes.
But I did jump ahead and look at... So this was, I think, filmed in 2020, end of 2020, early 2021. So they're kind of just taking over end of the season, into the next season. I did jump on the ladder just to see where they are at the moment. And
start following them.
Well, I'm not. I don't want to be a bandwagon jumper. I'm still Liverpool.
Just after the documentary,
just really interesting.
Membership skyrocket.
Well, surely it's part of the deal, right? But it was funny that this, National League, not even like they're semi-pro at best, are being sponsored by TikTok. Like, there's only one reason they're sponsored by TikTok is Ryan Reynolds, and they actually comment on that, and it's pretty funny. And these guys, they're happy to laugh at themselves. It's quite a good insight into them as well. So worth having a look at. You'll get a free trial for a week or two. That's plenty of time to knock over a few episodes.
Now the school holidays may be. Did you ever watch Moneyball?
No, I've never watched it. I've got it on my list, but I've never watched it.
You've never watched Moneyball? No. Man, you will really enjoy it.
Oaklandese, man.
And never watch Moneyball. You'll really enjoy it.
Yeah, okay.
That's not my tip, but that will also be a tip of mine.
Well, I keep referencing it. So Liverpool maybe weren't the first, but certainly one of the large proponents of using data in football. It wasn't really done, American owners and all that. But it's more and more, Brighton do it. There's a lot of clubs that use tons of data now to recruit and kind of work out where players fit in certain schemes. So, Moneyball, it's on my list. I need to watch it.
Did you ever see PM Capital do like a Moneyball kind of theme for their portfolio?
Oh, really?
Yeah, no. I'm like, man, really?
It's a stretch.
What are you guys doing, man?
What do you got, man?
So we went to dinner last week with some good friends of ours, and we went to Masti, Indian restaurant. I know you love your Indian.
I do like Indian.
So if you ever get a chance, because you know how we're always up and down on Brunswick Street because we're weird. Fitzroy, Brunswick Street.
You got the beard, you fit right in.
No, I've trimmed it. It's more
somewhat respectable,
sophisticated now. George Clooney look. Masti Indian restaurant. It was
so on Brunswick Street.
On Brunswick Street,
okay.
On the corner of Brunswick Street and some one-way road or street, I don't know. But it was lovely. It was cold outside. It was warm inside. Yeah, nice. The food was excellent. It's not. It's probably on the more expensive side, I would say. You could probably get cheaper Indian food locally, but it was a really nice experience. Walked in and it was just nice feeling. And I just love the smell of like Indian.
Oh man, yeah.
And our friends are Indian. And I sat down. I said, "Oh, mate, how you going?" I said, how good's the smell of this place? He goes, "It just fucking smells like my house." I'm like, "Can I come live with you for a little? I love this smell."
For a week.
So Masti Indian restaurant, if you haven't been, but like the mocktail, it's not cheap, man. The mocktails were like $20.
Yeah, right.
For mocktails. And after a reasonably good Thursday night, Friday, Saturday I was on mocktails on Saturday night. Yeah. Getting older.
So out of 10, mate, what do you give it?
I'd probably give it a 7.
Yeah?
Yeah.
Have you had better Indian?
It's been sort of more the traditional not dodgy, but it's just the local family that's running a restaurant. And everything's just done really well. But there's a lot of vegan options, which is fantastic.
Nice.
And a lot of gluten-free options as well. So, but the bread, oh man, the bread was.
Don't want to hear it.
Man, the bread was so good.
Really?
Yeah, just puffed up naans.
Yeah, just so good, man.
Yeah, really nice. So if you've ever been Masti on Fitzroy Street in Brunswick, we're going to take a break for a few weeks. We've got school holidays and whatnot coming up. And to avoid the government levy on fuel on the 28th of September, I'm jetting off to Bali for a little while.
Nice.
On the 27th.
Yes.
And so let me know how the fuel and diesel prices go.
Fill
whilst
up
I'm
your
over
jerry
there.
cans, people. Load it up.
And yeah, listen in on YouTube, hit us up, and we'll catch you soon.
Cheers.
My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management, AFSL 526798. The information contained in this podcast by me, my colleague Matt Rigby, or any of our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.